You cross the number, six figures. The salary that was supposed to change everything. And for about 3 weeks, it felt like it did. And then life quietly expanded to fill every dollar of it. And somehow, despite earning more than most people in your city, you still feel like you are running in place, still not saving enough, still not investing properly, still one unexpected expense away from stress, still wondering where it all goes. If that is you, this video is not about earning more. You already earn enough. This video is about the specific, silent forces that make six figures feel like nothing, and exactly what to do about them. Meet Adrian. Adrian is 34. He lives in a major city. He earns $115,000 a year, a salary he genuinely worked hard to reach. Promotions, skill development, a strategic job move 2 years ago that finally broke him into six figures. On paper, Adrian is doing well. In reality, Adrian has $4,200 in his investment account after 3 years of meaning to invest more seriously. He has $8,000 in savings that has not grown meaningfully in 18 months because something always comes up. He has a car payment, a gym he uses twice a month, 4 streaming subscriptions, a storage unit with things he has not looked at in 2 years, and a credit card balance that never quite reaches zero. He takes taxis because his time is valuable. He eats out most nights because after a long day at a high-pressure job, he has nothing left to cook. He upgraded his apartment when he crossed six figures because the old one no longer felt right for where he was going professionally. He is not reckless. He is not irresponsible. He is a high-performing, intelligent person who has fallen into a trap so specific and so common among high earners that it has a name: lifestyle inflation. But that is only one layer of the problem, because underneath lifestyle inflation, for most six-figure earners, there are three more forces quietly working against everything they are trying to build. And until you name all four, the income growth will keep disappearing. Every raise, every bonus, every side income, all of it expanding to fill the container. Let us name them. Force 1, lifestyle inflation. The one everyone knows but most people underestimate. When income rises, spending rises to match it. Usually within months, sometimes within weeks. The apartment gets upgraded, the car gets newer, the restaurants get better, the holidays get longer. The wardrobe reflects the new income level. None of these individual decisions feel irresponsible. Each one feels deserved. And that is precisely what makes lifestyle inflation so effective at neutralizing income growth. It does not feel like a leak. It feels like living appropriately for what you earned. But here is the mathematical reality. If you earned $70,000 and spent $65,000, you had $5,000 working for your future. If you now earn $115,000 and spend $110,000, you still have $5,000 working for your future. Your income grew by $45,000. Your wealth building capacity stayed exactly the same. The number got bigger. The gap between income and spending did not. Force 2. Tax bracket creep. The raise that is smaller than it looks. This one catches high earners by surprise repeatedly. When you cross into higher tax brackets, and at six figures in most countries, you are in significantly higher territory, a meaningful portion of each additional dollar earned disappears before it reaches you. In Canada, at $115,000, your combined federal and provincial marginal rate in most provinces is somewhere between 43 and 50%, meaning roughly half of each additional dollar you earn above a certain threshold goes to tax. In the UK, at that income level, your effective rate is in a similar range. In Australia, the US, and most developed economies, six figures puts you in the top marginal brackets where additional income is taxed most heavily. So that raise from $95,000 to $115,000 that felt like $20,000 more? After tax, in many jurisdictions, It delivered closer to $10,000 to $12,000 in additional take-home pay. And if lifestyle expanded in anticipation of the full $20,000, you are immediately behind. Most people never do this calculation. They see the gross salary number. They feel the lifestyle expansion. They never quite reconcile why the wealth is not following. Force 3. The identity cost of the income level. This is the one nobody talks about. At six figures, in most social and professional environments, there is an implicit expectation about how you live, where you eat, what you drive, where you holiday, and how you present yourself. Business dinners you feel you cannot say no to. Rounds of drinks you buy because you earn the most at the table. Weddings, destination events, and social obligations that come with a price tag attached to the income level of the group you are now part of. These are not freely chosen expenses. They are social taxes, and they compound quietly into thousands of dollars a year, spent not on what you want, but on what your income level appears to require of you. Force 4. The absence of a system, the most expensive force of all. High earners are often high achievers who are very good at their work and very bad at automating their finances. They intend to invest more. They plan to set up that automatic transfer. They mean to review the subscriptions, the insurance, the financial structure. But high-income jobs are also high-demand jobs. The same drive and focus that produce the income also produces exhaustion, limited bandwidth, and a tendency to defer financial admin indefinitely. The result is a high income flowing through a completely unoptimized system. No automation, no intentional allocation. Money arrives, life absorbs it, and the cycle repeats. Income without a system is a leaking bucket. The higher the income, the faster the leak. Let me show you what these four forces cost Adrian in real numbers. Adrian earns $115,000. After tax in his province, approximately $80,000 take home. Roughly $6,650 a month. Here is where his money actually goes. Rent on the upgraded apartment, $2,400. Previous rent was $1,700. Lifestyle inflation cost, $700 a month. Car payment on the leased vehicle he upgraded when he crossed six figures, $620. He previously had no car payment, took transit. Lifestyle inflation cost, $620 a month. Dining, social expenses, the professional social tax, approximately $900 a month. At his previous income level, this was around $400. Lifestyle inflation and identity cost, $500 a month. Subscriptions, storage unit, gym, and recurring services he has not audited in 2 years, $340 a month. He estimates he uses about $80 worth of this actively. Total visible lifestyle inflation and unexamined spending, approximately $1,820 more per month than at his previous income level. His income grew by roughly $3,200 per month after tax when he crossed from $70,000 to $115,000. His spending grew by $1,820 of that, more than half, within the first year. The remaining $1,380 additional monthly capacity, it is there. But without a system, it disappears into the general flow of his spending account. Sometimes it stays. More often, it does not make it to the end of the month with purpose. Now here is what happens if Adrian captures just $1,500 a month of that capacity and puts it to work. $1,500 a month invested at a modest 7% annual return. After 5 years, approximately $107,000. After 10 years, approximately $260,000. After 20 years, approximately $780,000. From the income he already earns. From money that is currently vanishing into upgraded living without compounding anywhere. Adrian does not need another raise. He needs to stop letting the raise disappear. Here is the system Adrian builds. Here is the system you build. Step 1. Calculate your actual take-home and build your budget on that number, not the gross. This sounds basic. Most high earners have never done it precisely. Get your last 3 months of bank statements. Calculate your actual monthly take-home after every deduction. Tax, pension contributions, benefits, everything. That number, not the salary figure you tell people, is your operating budget. Every financial decision you make should be based on it. Step 2. Run the subscription and recurring payment audit. Open your last 2 bank statements. Highlight every recurring charge, every subscription, every direct debit, every automatic renewal. For each one, ask one question. If this disappeared tomorrow, would I notice and care? If the answer is no, cancel it today, not eventually. Today. For most people earning 6 figures, this audit recovers between $200 and $600 a month in spending that is generating zero value or satisfaction. It is pure friction that accumulated silently as income grew. Step 3. Automate the investment before lifestyle absorbs it. This is the most important structural change you can make. On payday, before you pay rent, before you buy groceries, before the social calendar hits, a fixed amount moves automatically from your income account into a separate investment account, not what is left over. First, at 6 figures, the amount should be meaningful. At minimum, 10% of take-home pay. Ideally 15 to 20% if your fixed costs allow it. That is $665 to $1,330 a month on Adrian's take-home. This money is not available. It does not exist for lifestyle decisions. It moves before you see it, and it compounds silently while your life continues. Step 4. Set a lifestyle ceiling and hold it deliberately. This is the one most finance advice skips. Choose your lifestyle number consciously, not reactively, not based on what your income allows, but based on what genuinely makes your life good versus what is just maintenance of an image. Adrian's apartment upgrade added $700 a month in cost. Did it add $700 a month in life quality? Honestly, probably not. The decision was reactive, made because the income arrived and upgrading felt appropriate. Going forward, every significant lifestyle increase should pass one test before it happens. Does this add genuine value to my daily life? Or does it just match what someone at my income level is supposed to have? The second category is the identity tax, and it is optional, even when it feels mandatory. Step 5. Use tax-advantaged accounts aggressively. At 6 figures, tax planning is not optional. It is where thousands of dollars are recovered every single year. In Canada, maximize RRSP contributions before the deadline. Every dollar contributed reduces your taxable income directly. At a marginal rate of 43%, a $10,000 RRSP contribution saves you $4,300 in tax immediately. That is a guaranteed 43% return on that contribution before the investment does anything. Maximize TFSA for tax-free growth on everything above the RRSP. In the UK, use your ISA allowance fully. In the US, max your 401k contribution, then Roth IRA. In Australia, consider voluntary superannuation contributions at higher income. In every jurisdiction, the tax system has tools specifically designed to help higher earners reduce their burden. Using them is not clever accounting. It is basic financial hygiene at 6 figures. Step 6. Hire a fee-only financial planner for one session annually, not an advisor who earns commission on what they sell you. A fee-only planner who charges a flat fee for their time and has no financial incentive to recommend any specific product. One session a year. Review your tax structure, your investment allocation, your insurance, your income protection. At 6 figures, the complexity of your financial picture justifies professional eyes on it once a year. The cost of that session, typically $300 to $800 depending on market, is almost always recovered multiple times over in optimizations you would not have found alone. Here is the reframe. Most people treat income as the solution. Earn more and the problems resolve. Reach six figures and the financial anxiety disappears. Get the next raise and the wealth will finally start to accumulate. But income is not the solution. Income is the raw material. What you build with the raw material depends entirely on the system you run it through. A high income through a leaking, unoptimized, lifestyle inflated, unautomated system produces exactly what Adrian has: good life, no wealth. Constant, mild financial stress that makes no logical sense given the number on the payslip. The fix is not another raise. The fix is building a system that captures what the income already produces before lifestyle, taxes, social pressure, and inertia absorb it. The wealthiest people at six figures are not the ones who earn the most within that bracket. They are the ones who decided, usually once, clearly, and deliberately, what their lifestyle costs, automated the gap into assets, and then let compounding do the rest. They did not find more money. They stopped losing the money they already had. You earn the six figures. That part is done. That part is real. Give yourself credit for it. But the income is not the finish line. The income is the starting line for everything that actually matters financially: the freedom, the options, the security, the ability to make choices based on what you want rather than what you need. And right now, without a system, you are standing at the starting line watching the race happen without you. Not because you do not have what it takes, because nobody showed you that the race requires a different set of skills than the ones that got you to six figures. Earning more requires drive, performance, and ambition. Building wealth requires automation, intentionality, and the discipline to let your money work instead of spending it on the life your income is supposed to look like. Adrian has the income. He just needed the system. Run the subscription audit this week. Calculate your real take-home. Set up the automatic investment on payday. Open the tax-advantaged account you have been meaning to open. Not perfectly, not all at once. One step this week, then the next. Because the six figures you work so hard for deserve to build something that lasts longer than the month they arrive in. Drop a comment and tell me honestly, which of the four forces hits closest to home for you? Lifestyle inflation, the tax bracket surprise, the social pressure of your income level, or just the absence of a system? Tell me where the leak is for you. I read every comment, and I will tell you exactly what I would fix first. If you know someone earning well who cannot figure out why the wealth is not following, share this video, because this is the conversation that income alone never triggers. Subscribe to Noella Invests, because earning more is only half the equation. Keeping it is where the real work is. And we talk about both. See you in the next one.